Hello and welcome. If you're using Trading 212 in the UK, you are in exactly the right place. In this discussion, brought to you by the experts at Pro Tax Accountant, we're going to walk through everything you need to know about your tax obligations. Our goal is simple, to help you invest smartly and, crucially, stay on the right side of HMRC. So, you've logged into your Trading 212 account, you see that flash of green. You've made a profit. Seriously, congratulations. It's an amazing feeling when your hard work pays off, right? But almost immediately, that little voice creeps in. What about the tax? Getting this bit wrong can be a really expensive mistake, so let's make sure we get it right, together. All right, first things first, let's talk about your core obligations. A really common and honestly dangerous mistake is thinking that Trading 212 somehow handles all the tax stuff for you. It's easy to see that money sitting in your account and think, great, it's all mine. But unfortunately, here in the UK, it just doesn't work that way. Okay, if there's one thing you take away from this, let it be this. Trading 211 does not handle your UK taxes. It is entirely up to you to calculate your profits, report those profits and end dividends to HMRC, and pay what you owe. Think of yourself as the CEO of your investment portfolio. The buck really does stop with you. And trust me, ignoring this can lead to some pretty nasty penalties and interest charges down the road. So the main tax you're going to be dealing with is capital gains tax, or CGT. Now, there's some good news here. You've got a tax-free allowance. For the 2025-2026 tax year, you can make up to £3,000 in profit before you owe a single penny. So if your total profit for the year is, say, $2,500, you're all good. Nothing to report, nothing to pay. But if you make more than that, the rate you pay on the extra bit depends on your income. It's 10% for basic rate taxpayers, and that jumps up to 20% for higher and additional rate taxpayers. And here's a little pro tip that catches so many people out. Capital gains tax only kicks in when you actually sell your shares and lock in or realize that profit. If your portfolio is just growing in value on the screen, that's fantastic, but you don't owe any tax yet. It's that physical act of hitting the sell button that creates what's called a taxable event. So you're in complete control of when that tax bill gets triggered. But it's not just about selling shares for a profit. If the companies you invest in pay out dividends, well, that's taxable income too. And for the 2025-2026 tax year, the tax-free dividend allowance is just £500. I mean, that is incredibly low. You could easily go over that with even a pretty small portfolio. Any dividends you get above that tiny amount get taxed, and the rates get steep, fast. 8.75% for basic rate, a whopping 33.75% for higher rate, and nearly 40% for additional rate taxpayers. Okay, now for a really crucial question, one that HMRC is very interested in, and it can totally change your tax bill. Are you an investor or are you a trader? You might think they're the same thing, but for tax purposes, it's a world of difference. Here's the trap. If you're trading all the time, maybe buying and selling daily, holding things for just a few hours, HMRC might look at that and decide you're not just a casual investor. They might say you're actually running a trading business. And if that happens, your profits are no longer taxed at those nice low capital gains rates. Oh no, instead they get taxed as regular income at your personal rate of 20, 40, or even 45%. This is a massive pitfall for really active users. Okay. I know, hearing about all these different taxes and tricky rules can feel a bit much, right? But don't worry, because there is an incredibly powerful tool that every single UK investor should be using. Let's talk about your ultimate tax-free shield, the Stocks and Shares ISA. This number right here is your golden ticket to tax-free investing, £20,000. That is your annual ISA allowance for the 2025-2026 tax year. It's a use it or lose it deal each year, and honestly, it is hands down the most powerful tool a UK investor has for building wealth without the tax headaches. So what exactly is a Stocks and Shares ISA? Well, the easiest way to think of it is like a tax-proof wrapper that you put your investments inside. As a UK resident, you can stick up to $20,000 a year into this wrapper. And here's the magic. Any profits you make from selling shares inside it and any dividends you receive are completely 100% tax-free. No capital gains tax, no dividend tax. It really is that good. Let's just put that side by side. In a standard invest accounts on Trading 212, every single profitable sale and every dividend payment could create a tax bill. In an ISA account, you could make £1 million in profit and you literally wouldn't owe a penny of tax on it. The only catch, that £20,000 per year limit on what you can put in. But for the vast majority of us, maxing out that ISA allowance every year is the single smartest financial move you can possibly make. Now, the ISA is a fantastic solution, but look, a lot of people also use a regular taxable account, especially if they've already filled up their ISA for the year. And once you're playing in that taxable world, there are some notoriously tricky rules and common traps you absolutely have to know about. This is where it can get seriously confusing. When you sell some of your shares in a company, you can't just tell HMRC, oh, I sold the cheap ones I bought years ago to make my profit look bigger. Nope, HMRC decides for you using these really strict share matching rules. First, they match sales against any shares you bought on the same day. Then, and this is the weird part, they match the sale against any shares you buy in the next 30 days. This rule is specifically there to stop people from selling and immediately rebuying to play the system. Anything that's left over gets pooled together at an average price. It's confusing, and believe me, it is so easy to get wrong. And there are a few other common traps you need to have on your radar. Trading CFDs? Those profits could be hit with higher rate income tax. Spread betting is often sold as tax-free, but HMRC can tax it if it looks like you're running a business. And here's a really sneaky one, foreign currency. Let's say you buy a US stock. You make a profit in dollars, and then the pound weakens before you switch your money back to sterling. That extra bit you made just from the exchange rate, that's taxable too. And a final pro tip, always report your losses to HMRC. Did you know you have 4 years to claim them? You can use those losses to slash your tax bill on future gains, so don't leave that money on the table. As you can probably tell, this stuff can get complicated and fast. Between share matching rules and foreign currency gains, it's basically a minefield for the average investor. So when does it make sense to just stop guessing and call in the experts? Well, let's look at a real-world example to see the incredible difference that professional help can make. Let me introduce you to Awais, a software developer from Sheffield. He'd done really well for himself, making £18,000 in gains. But when he tried to figure out the tax himself, he was looking at a massive potential bill of £7,800. He'd miscalculated his capital gains, he had no idea his CFD trading could be taxed as income, and he'd totally missed out on claiming foreign tax credits. It's a classic example of how a few small, understandable mistakes can add up to one huge tax headache. So Awais got in touch with Pro Tax Accountant, and here's what they did. First, their team untangled all those complex share matching rules to figure out the correct cost of his shares. Then, they successfully argued with HMRC that his CFD trading wasn't a business, meaning it should be taxed at the lower capital gains tax rate, not the higher income tax rate. They also dug up £5,000 in previous losses he could use to offset his gains, and they claimed £450 in foreign tax credits on U.S. dividends that he had completely overlooked. They basically looked at his situation from every single angle to make sure he was being as efficient as possible. And here's the bottom line. The initial tax bill Awais was staring down was a terrifying £7,800. After the experts at Pro Tax Accountant worked their magic, his final correct bill was just £3,400. That's a direct saving of £4,400. That's a family holiday, that's a new laptop, that's a serious boost to your investment pot, all from getting an expert who knew exactly where to look. So after hearing Awais' story, you've got to ask yourself a serious question. He saved over £4,000 for mistakes he didn't even know he was making. How much could you be overpaying right now without even realizing it? Look, if any of this sounds overwhelming, or if you just want that complete peace of mind that comes from knowing your taxes are handled perfectly and you're not paying a penny more than you legally have to, it might just be time to take the stress out of it all. The experts at Pro Tax Accountant are there to help. And they make it super easy to get in touch. You can reach them directly on WhatsApp or give them a call on 07985 689 912. Or, if you'd rather, just ping a quick email over to info@protaxaccountant.co.uk. They are ready to help. And finally, if you found this discussion helpful and you want to stay ahead of the curve, make sure you hit subscribe on the Pro Tax Accountant YouTube channel for more expert tips on navigating UK tax. Thanks so much for joining us, and here's to happy, profitable investing.